Hey guys, Jeb Gerald here with Plentiful Wealth. Thanks for joining me today. I'm going to keep this pretty short. It should be about 15 minutes. And today I'm going to tell you about how to make your money go further when you're giving to charity. Odds are, if you're watching this, you're already donating to charity. Maybe that's giving to the Humane Society, maybe that's giving to your church, or maybe it's your fraternity. Whatever your favorite nonprofit is, you're probably already giving. What I'm going to talk about is how to make that dollar that you're giving go further. And I mean that in two different ways. The first is make that dollar go further for the charity so it'll have a bigger impact. And then I'm also going to talk about, and I'm going to show you how to get a bigger tax deduction or get the entire credit that you're entitled to from the IRS. I want to show you a couple different strategies for giving gifts that might be different than you're already doing. Maybe right now you're just writing a check, and I'm going to show you how to give more efficiently so that money is going to go further. With that, I'm going to jump right in. I already mentioned this, but I am the principal of Plentiful Wealth. If you have any questions, feel free to reach out. I'll have my information at the very end of the slideshow. Let's start out by talking about changes that were made to the tax code under the CARES Act. There were a couple of big ones. The first is that now you can give more and actually get a deduction for it. In the past, you were limited to 60% of your adjusted gross income as a tax deduction each year. Now, because of the CARES Act, that's been raised to 100%. So that means that if you have a really big year, maybe you sold a business, maybe you came into inheritance, something along those lines, and you have a bigger tax bill and have a higher AGI, you can also give more to offset that. The only downside to this is that a gift to a donor advised fund doesn't qualify for the increased contribution limit. The other thing is that there's also a $300 above the line tax deduction for any charitable giving. What that means for you is if you're not able to itemize your deductions, most people aren't, they're taking the standard deduction, that you can still write off $300 in charitable giving. So make sure that if you're giving, even if you're not itemizing, that your tax preparer is taking advantage of that deduction. Next up, I want to talk about why people give, because this kind of leads into making your dollars go further by the strategic gifting that I want to talk about. The biggest reason why people give, the reason why I give, is because I want to make an impact. There are organizations that are really important to me. St. John's Center for Homeless Men is a big one for me. That I see the work they're doing. I see that they are getting men off the streets into affordable housing, into the permanent supportive housing that is going to get them what they need. And so for me, it makes sense to give to them. I love their impact. For others, maybe it's giving to the FFA Foundation. They're a great organization that really is doing great work in getting the next generation of farmer the education and the experience they need to be able to be productive farmers. Or maybe, maybe it's your church. There's no wrong answer here. But the point being that people give because they want to make an impact. They don't give to make themselves feel good necessarily, or because they want the recognition, or because they want the tax benefits even. Most people don't give for the tax benefits, and frankly, you shouldn't give only because of the tax benefits. Now, that's not to say you shouldn't take advantage of them, because you totally should. The tax benefits are there because the government sees that there's a benefit to giving to charity, and they want to reward that. They want to incentivize you to give. So you want to make sure you take full advantage of that, and that's what I'll talk about later on in the second part of this presentation. But at the end of the day, people give because they want to make an impact. So let's talk about how you can make your dollar go further. And first, we need to look at where most gifts go wrong. The first thing is the exact opposite of why most people give. They don't have a lot of impact. If you're like me, at the end of the year, I'm recording this on the 1st of January, I'm getting, especially during December, I got a ton of letters and cards, asking me for money from every organization I've ever been involved with. And it's really easy just to write a check, $20 here, $30 there, just so you can feel good about it. Because most people don't like saying no. I don't. I understand that. The problem with that is when you shotgun your money, or at least that's what I call it. It's, unofficial term. It doesn't have a lot of impact because you're not making a gift that's big enough to really move the needle. So they don't have a lot of impact. A lot of times gifts won't have an integration with the overall financial plan. And I see this going back to writing a check. there's almost always a more tax efficient way to give than just write a check, whether that's giving appreciated stock or a qualified charitable distribution or any number of other things, which I'll talk about here in a few minutes. But the gifts that I see often just don't make an impact and they aren't tax efficient. So let's talk about how to fix those two problems. The biggest thing that you can do to make your money go further and to have a bigger impact is to look at strategic gifting. Strategic gifting is essentially just giving with a purpose. That's trying to start at the end goal that you want to achieve and say, okay, this is the impact I want to have. For me, maybe it's I want to be able to get one man off the streets, or one person, get one family into long-term housing, or maybe I want to provide start a program for education for high school graduates in Eastern Kentucky. There's no wrong answer here. The important thing is that you find what's important to you, and then you can work back from that. So you have a strategy, you have an end goal. Well, you start out with the end goal, and then you build a strategy to support that. And instead of giving 20 gifts or 10 gifts or whatever number that is, you're going to give 1 or 2 really big gifts to support that. So for me, like I said, housing, or, I'll talk about veterans for a second. I'm a veteran myself. I was in the Army. So I've got a soft spot for veterans. Maybe I want to support veterans, and I say, known a couple of guys that died by suicide. And so maybe I want to support veterans advocacy in the area of suicide awareness and suicide prevention. So the next thing is to look for organizations that are already in that space. A great one is USA Cares. I do a lot with them. I was actually on their podcast a couple weeks ago, and they're a great organization. So once you find an organization that's active in that area, partner up with them. And most organizations are going to be happy to talk to you, especially if you're giving more money and if you want to be involved, they're going to want your help and they'll be happy to take your input. So reach out to those organizations. Build a strategy with them to achieve what you're looking to achieve. Make sure that it's realistic. You have to make sure that what you're giving is enough to do that. Or, maybe it's recruiting friends. Maybe you want to raise money to endow a scholarship. You have a lot of options there. But strategic gifting is essentially giving more to less organizations with a strategic end goal in mind. So there are 3 things you want to make sure of when you're looking at strategic gifting. First is select doggedly. And this is just, like I said, picking one cause, one organization, one thing that really speaks to you, and give to that organization. Next up, be criteria driven. And that just means make sure that the organization you're supporting is actually doing what they say. We've all heard stories about organizations that spend 80 or 90% of their budget on fundraising. You probably don't want to give money to them. So you want to make sure that when you're looking at your organization, that they're actually achieving what they're supposed to. You can do this many different ways. I always like to check out Charities 990 forms. You can find these on charitynavigator.com or actually even the IRS website. And you can see exactly how much any organization has spent on salaries, on overhead, on just office expenses, rent, as much as mailers. They break it all out. This can be really beneficial for you, so you have a pretty good, decent idea of what's going on in this organization, where they're spending their money. And then from there, you can also look at, with more qualitative methods, at what their actual impact has been. So I think being criteria driven is very, very important. And then finally, use larger gifts. This is where planned giving comes in. Instead of just writing a check, maybe you include them in your estate plan. Maybe you make a bigger gift of appreciated stock, or any other number of items that we're going to talk about here in a few minutes. But you want to make sure that you make larger gifts here, rather than shotgun your gifts. So now we talked about how to make your dollar go further on the actual nonprofit side, on the charity side. Let's talk about how to make your money go further when it comes to the tax side and the actual tax planning. So with that, I'm going to show you a couple different charitable giving techniques that can make a huge difference in your giving. The first is qualified charitable distributions. This is one of those things that I do this with almost all of my clients who have required minimum distributions. What I see often is I'll have clients who are in their 70s. They have pensions, they have Social Security, maybe they worked at Ford or GE, and their pension really covers most of their expenses. They also have a retirement account, whether it's an IRA, 401k, 457, anything like that. And so for that retirement account, they're also required to take a requirement of distribution each year. And they say, Jed, I don't need that money. What am I going to do with it? My expenses are covered by the income I have coming in each month. And so I'm going to have to take this money and I'll have to pay income taxes on it, even though I don't need it. The great option is you can use qualified charitable distributions. And this is essentially just writing a check to a nonprofit from your IRA. If you had a $10,000 RMD each year, you're already giving $10,000 just out of your regular cash flow. You could just cut a check from your IRA to your church, and that's going to take care of your RMD for the year. It's not going to count as income for you. It won't count as income for the nonprofit, and the only person that misses out is the government's won't be getting any tax money off of it. It's the best of both worlds. So you also don't have to itemize this either. So if you're thinking, hey, well, I don't want to itemize or I can't itemize my deductions, it doesn't matter. This is an above the line deduction. It never shows up as income. So it can be a really great opportunity for you. Next up is gifting appreciated securities. This is an opportunity I see a lot for people who work at UPS. Many UPS retirees end up with UPS stocks. They've been working there for 30 years. And UPS stock's done really, really well over that time frame. So when you look at it, you can kind of back it out. And I see people that say, Jeb, I've got, $150,000 in UPS stock. I can't really do much with it right now because it has a really low cost basis. So if I sell it, I'm going to pay way too much in taxes. What can I do with that? One of the things that I will recommend is that they will actually gift some of that stock in lieu of writing a check to a nonprofit. The cool thing here is if you give $50,000 worth of stock, it doesn't matter what the basis is. You don't actually have to sell the stock. You shouldn't sell the stock, in fact. Instead, you get the stock, you get the deduction for the fair market value of the stock on the day you transfer it over. So $50,000. Whenever your church or charity receives that stock, they can sell it. They can then take the $50,000 and use it for whatever needs to be done. They don't have to pay taxes on it. So by transferring the stock instead of selling it, you're not going to pay taxes. You get the gift, you get the deduction for the fair market value, and everyone wins. So definitely keep that in mind. Like I said, UPS comes up a lot. GE and Ford also come up. It can be really beneficial here as well. Next up is gift. Oh, I'm sorry. I managed to knock the desk with my knee. Next up is gift bunching. And what gift bunching is accelerating your gifting up a year, essentially, sometimes 2 years. So what I mean by that is, for instance, if you gift $10,000 per year to charity every year. So if you can look at the chart here, 10,000 in 2018, 10,000 in 2019, so on and so forth until 2021. That would be the typical setup. Gift bunching would be making a $20,000 gift in 2018, no gift in 2019, and then another $20,000 gift in 2020. The benefit here is by gifting up more in alternating years, you're actually going to be able to qualify for itemizing your deductions. Whereas if you just give the $10,000 each year, you can still itemize, but you're only going to be able to itemize $2,000 above the standard deduction. Whereas in these 2 years, you'd actually be able to itemize $12,000 each year. So the difference here is $2,960 over 4 years as far as deductions go on a standard 10-year, $10,000 per year contribution versus almost a $9,000 savings over here. What you can do is actually tying gift bunching with, and actually I don't have a slide for it, I apologize, with donor advised funds, which essentially work as a nonprofit or a charity bank account. You gift to the donor advised fund, and then the money just sits there until you're ready for it to be used. But you get the deduction as soon as you put the money, or you can even give appreciated stocks into there, and you're going to get the deduction immediately. So you could give $20,000 in this year, give $10,000 to a charity this year, and then give $10,000 next year to a charity. So they're going to still get the exact same amount they normally would. You're going to get tax benefits out of it though. Next up is using a charitable beneficiary, and this is super simple. It's one of the easiest ways that you can give to charities. All this means is if you have a retirement account, say a 401k or an IRA, it's just adding them as a beneficiary on that account. You could say, I want to give $10,000 out of my IRA when I pass away. It's easy to do. You could set it as a percentage. Maybe you say, hey, I want to give 10% of my IRA to a charity when I pass away. All you need to do with this is reach out to your financial advisor, or whoever your custodian is, Schwab, Fidelity, Vanguard, and ask them for the forms. It's super easy, and it's a great way to make sure that once you pass, that your legacy is going to be carried on, and that there's still going to be impact from your gifts even long after you're gone. One other thing that you can do is you can gift life insurance, and most people think of gifting life insurance as just putting the charity as the beneficiary. What you can do is if you have what I see pretty often is people have whole life insurance policies that they bought 30 or 40 years ago. And they're at the point now where they're financially independent. They have income, they have assets, and they don't need the insurance. So what you can do is you can actually gift the policy. You'll get a deduction for the current value of the policy. The charity will get the policy, and then they'll be able to set themselves as the beneficiary for when you do pass. And so you're going to get a tax deduction now, and the charity will eventually get the value of that life insurance. It's, again, a win-win situation. So one of the things, too, that I mentioned was a lot of people don't integrate charitable giving into their financial plan. What I mean by that is these techniques need to be paired with other things as well. So if you have a charitable deduction, or if you have a deduction from giving to charity, you can pair that with a Roth conversion. You can pair that with any number of things, and it can be really beneficial for you. So you need to make sure that your financial advisor, your accountant, is taking that into account. Gift bunching, we talked about that a second ago. It's one of my favorite things to talk about. It's one of my favorite things to do because it can be so valuable. And finally, just having an overall plan. Talk to your financial advisor. If you don't have one, give me a call. I'm happy to help. We can always go through this. But building a plan that includes your charitable giving, that includes, what impact that you want to have and what impact you want to leave on this world, and making sure that it happens. So if you have any questions, I would love to chat. Again, my name is Jeb Gerald. I'm with Plentiful Wealth. You can email me at jeb@plentifulwealth.com or give me a call at 606-775-0246. Thanks.